Investors um, live. And if you are not a member of Berkshire Hathaway Investors, make sure you become a member. I missed two of these because I was down in Florida, hadn't been down there for a little while. So had to go follow up on all the new construction that we have going on. And congratulations to everybody from Mastery. There's almost, I think, 65 to 70 properties that are under shell at this point. So it's exciting because you get to see property after property after property after property that is being developed from Mastery. A quick reminder for everybody that's joining in, they're at D'Agostino's Pizza and Pub in Wrigleyville. It's 1351 West Addison Street. On March the 28th, 6:30 p.m. We have, I'm trying to think who's hosting it. Blake is hosting a real estate investors meeting. So go out there, support if you're in the city, be a part of it. And I'm not sure what the agenda is, but it's supposed to be lots of networking for a bunch of real estate investors. So it'll be a great event in the city. Again, that is 1351 West Addison, D'Agostino's in the city in Wrigleyville. And it's at 6:30, March 28th. Having said that, let's get started. Today, we're talking about some of the real estate terms that a lot of times we hear about, but what do they really mean? So let's first kind of start with the very, very beginning before we jump into this. And we're going to start taking different terms at different times and kind of start covering them in terms of our understanding of real estate. So, and some of these are coming in as we speak. So that's what I'm kind of looking at the computer. So the first one we're going to start with is first one is investing, right? Because that's obviously what we all do. And this is something I have the greatest amount of challenge with a lot of people, because a lot of times people want to be investors, but they don't understand investing. So what do I mean by that? Well, there are three types of different people. Number one, and this is very critical. If you're somebody that is listening, this is important to understand. Number one is, what does investment mean? Investment to me means you're buying something of this much value. Let's just say it's $100. You're buying it for $80, $70, $60, $40. That is investing, meaning you're buying something that is of a lot more value and you're buying it at a really good price. So that means I invest $60 and yet that particular thing is worth $100, $150, $200. That's investing because there's a large margin. Now, what if I buy something for $60 and I have to do $40 in improvement? Or to put it in property terms, what if I buy something for $60,000 and I have to do $40,000 in improvement? That's okay. That's still investing. But then what has to happen is the value after fixing it up, meaning if I buy it for $60, if I improve it for $40, then the value of it needs to go up by maybe to 150, 160, 170. That is an investment, right? That is, it's basically, if I buy a property, let's say I want to live in a home, right? The other day I went and looked at a property. It was listed on the market about 1.4 million. At one time, the same property had been on the market for $7 million, $7 million bucks, right? And I went and looked at it because it had this in-ground pool and it was inside the property, meaning indoor in-ground pool. And I'd always wanted a property with an indoor in-ground pool. Now, if you think about that subdivision in the area, the houses are generally worth $3.5 to $4 million, right? So if I buy this property, I'm going to probably end up spending about anywhere from $600-700 to $1 million almost, right? Depending on, it's a very large property, has a lot of things that need to be done to the property because it's dated. And if I'm going to buy a property like that, I'm going to basically have to really redo the property and do it right all the way. Now think about it. Even though I can pick up the property for $1 million, I do $1 million in work. And then, yeah, the subdivision, are there more expensive houses in the subdivision? Yes, there are, right? There are $4 million, $5 million houses. The problem is this with this particular property, that it would not be called a investment. And here's why. Because if I wanted to sell it, do you really think I could sell that property? Now, would it be a fabulous house to have a lot of friends over, everybody from Mastery over, throw a huge party and brag about, oh my God, I bought this property, it was on the market for $7 million, man, I picked it up for $1 million. Sure, right? Would it be honest? Sure. But would I call it an investment? No. And here's why. Just because the properties in the area, meaning in general, there are houses that are built 3 million, 4 million, and that's kind of what that area is, right? It's got a gated community, the whole 9 yards. The problem is this: if I went to sell that house, I don't think the property is worth more than 2.5 to 3 million. Will I get an appraisal for 3.5 million? 100%. No doubt in my mind, I would get an appraisal for it. The problem is this: I don't feel confident that I can sell it for that kind of money, because with these types of houses in Oak Brook, that would be a unique property and I would have a hard time selling the property. So to me, it would not be an investment. It would be something I am buying to live in. And when I go to sell it 2 years, 5 years, 10 years from now, if I get a little bit more for it, great, that's fine, right? But I would not call that an investment, right? To take it on the other side. I just bought a property down the street, literally from our main office in Oak Brook. I paid $240,000 for $235,000 for the property. I did about $35,000 in work. Now, so my all-in cost, purchase plus rehab, is about $275,000 or so. The value of the property came in at $410,000. That is an investment, because I can get a return on the money that was invested, and that return can be gotten in a reasonable amount of time. So that becomes an investment if I'm buying a home for me to live in, right? Even though I may have gotten it for a decent value, unless it's going to be worth that much more, it's not an investment. It's just something that I wanted to buy to live in and enjoy, or to satisfy my ego. So that's number one. Number two, and this is like, why are we talking about definitions, which is second one, and that is a flip, a rental, and a wholesale. This is something I want to cover really on the front end of this, because this is a question comes up all the time, right? This question comes up whenever people get into real estate. Well, should I be doing flips? Should I be doing rentals? Should I be doing wholesales? And this is my belief system. You have to do rental properties over long term if you intend to build wealth. But a lot of times what people do is this: they will get into real estate and they're like, well, I'm a wholesaler. Well, what does that mean? Does that mean that so a lot of times what that means to people is that they get a property under contract and they wholesale that contract for a profit, which is fine. Nothing wrong with that. But does that mean that you don't want to own properties? You don't want to build wealth? No, everybody wants to build wealth. Everybody wants to have cash flow. See, what you should be looking for is not a flip, is not a wholesale, is not a rental, or is Airbnb. What you should be looking for is a great deal. Because when you have a great deal, guess what? You can always wholesale it if you choose to. You can always flip it if the numbers are right. You can always put it as a rental, or you can always partner up, give it to somebody else. They can help you partner up on it and keep it as a rental or as a good quality Airbnb, right? That should be the goal all the time, is to look for a great property. So if anytime anybody says, hey, what do you do? Well, I look for great properties. If it's for a flip, great, I'll take it. If it's for a wholesale, I'll take it. If it's for a great rental, I will take it. Now the question becomes, is your exit strategy can be any one of the three, depending on what makes the most sense. So for me, every property that I look at it through the eyes that I want to own it forever. Now, if it's not a good property to own forever, then guess what? I'm going to get rid of it through either a wholesale or a flip. But what I really, really, really want is properties that I never, never, never sell. And then if I'm going to keep it for long term, great. Otherwise, I'm going to do an Airbnb or a midterm rental so I can keep the property forever. Now, having said those two things, now let's reach into the definitions. So as you would have it, the first thing that came up, what is the definition of cash flow? Well, The only definition of cash flow is, so cash flow can work two ways. Cash flows in and cash flows out. A lot of times when people think about cash flow, they only think about, well, cash flow, meaning you make money at the end of every month. Well, not necessarily. Think about it. What is your job? It is a cash flow. You just have to run on a treadmill to create that cash. You're trading your time to create cash. But the problem, what happens for most people, cash flow comes in because the amount of time they trade out. So let's just say you make $6,000 a month. If your living expenses are $6,000 a month, what is your net cash flow? Zero. There's nothing wrong with it, right? But that's just what your net cash flow is, right? For most Americans, they're pretty close to broke. And mind you, nobody plans on that. We just fail to plan. Right? Nobody wants to be broke by choice, understand, right? But yet what happens is generally, and this would be something to keep in mind, that did you realize that there are a lot more people that make $60,000, $70,000, $80,000 that save at a higher rate than people who make $100,000? I bet you didn't know that. Right? Because most of the times we think that people who make more have the ability to be able to save more. Actually, a lot of times that is not the case. Sometimes people make a tremendous income. They just happen to spend a tremendous income, right? So if I look at me, one thing I'm really good at is I invest before I ever spend. Right? And somebody said this to me way, way, way long time ago. They're like, if you stacked up all the checks that you write every single year for investing versus for your personal expenses, the day the stacking of checks, which is, it was a term, obviously, not in real life. You're not going to stack the checks and look at them, but meaning is that you're writing way more checks towards your investments than towards your personal spending. Guess what happens? And my ratio every year always was, my goal always was this, that I want to spend 10% of my actual total income on me, right? And now this year is probably the first year I've ever been able to accomplish where compared to my personal income, what I invest is more than 10 times than what I spend. So I spend about 10% or less of my earnings. Now it's taken me, mind you, today I'm 47 years old, right? So it's taken me, I was thinking about this when I was in my 20s. It's taken 20 some years, 25 or so years to get to this point. But when we think about cash flow, see, the only way you're going to have a lot of cash flow that comes in is when your investments way outweigh your spending. And the only way that is going to happen is you have to think about it first. So when we talk about what is cash flow, to me, cash flow is a condition where you have 6,000 coming in and 5,000 going out, right? If that's the case, you have cash flow, and more positively, you have positive cash flow. Now, the next thing is cash on cash return. What does that mean? Well, this is an important term to understand. What cash on cash return means is this: how much cash did I put out of my pocket to be able to make a return on a particular investment, right? Why do I think real estate is the number one? And I mean it, number one, and I'm not exaggerating this, and I'm not saying this because I pulled this out of thin air. I have a reasoning behind it. I want to explain the reasoning. It's the number one vehicle for building wealth. And here's the reason behind it. Because real estate is the greatest equalizer for all of us. Here's the reason. So think about this. If you're going to invest in the stock market, if you're going to invest in the cryptocurrency, if you're going to invest in gold, if you're going to invest in anything else, right? Real estate is that singular vehicle where you can actually find a property, borrow somebody else's capital, invest in that property, increase the value with somebody else's capital, make a huge profit for you, and be able to pay them back their money as well as a return on it. Now, somebody will say, well, couldn't you do that with stock market? Sure, you could, if somebody's willing to give you 100,000 against 100,000 in stock. But try going to a bank and ask them, hey, I'm going to buy GM stock for 100,000. Can you give me, Mr. Banker, 60,000, 70,000, 80,000, 100,000 against that stock? See, real estate is very unique in that way. Can't do that with crypto, can't do that with precious metals. In real estate, you could literally go to your friend and say, hey man, do you have $10,000 as we can go into a partnership, do a flip, or we can own rental properties. Can you put up a little bit of the money? We're going to invest that. I'm going to do the work, find a deal. We're going to invest that into a property. And then the profit that we're going to make, we're going to split that 50-50. He's like, well, how do I come up with the rest of the money? Because I only have 10% down. I only have 15% down. Well, guess what? You can go and borrow that from the bank. So if I'll give you an example of the first property that I ever bought. So the first property that I ever bought was a very small profit. It wasn't a very big profit, right? It was a very small amount of profit, but I'll show you exactly how it was done. So I borrowed $20,000 from Chase Bank at the time on a home equity loan, right? So what is a home equity loan? I went to Chase Bank and said, Mr. Banker at Chase, I have a townhouse that I live in Bartlett, and I would like to get a home equity loan on some of the little bit of equity that I have in the property. At that time, I only got a home equity loan for $20,000. That's it. Right? That was it. That was my start. This is 2008. I went to a friend of mine and I asked him, I'm like, hey man, I'm thinking about buying a property, and then we can do I can basically get some work done. And I think when we sell it, we're going to make a little bit of a profit, right? And so he put in $20,000. So now I have $40,000, 20 plus 20, I have 40. I took about $25,000 and put that as a down payment. Now, if you think about it, where did my $20,000 come from? Well, it was leveraged from Chase on a home, on a little townhouse that I used to live in Bartlett. And that was my investment capital. So did I have really money out of my own pocket? No, I had zero out of my pocket. I had borrowed that money from Chase. As long as I pay Chase back under the terms that are agreed, right, I can pay it back over a period of a year, 2 years, 4 years, 10 years, 15 years. What am I going to have to pay? I'm going to have to pay interest on my home equity loan, but that's about it. As long as I keep making the payments on time and on schedule, I'm good. I can make millions and millions of dollars with the Chase money, and I can make millions of dollars with my friend's money. As long as he gets a return, he's happy. And as long as Mr. Chase gets the interest rate that they were charging at the time for my home equity loan of 3.5%, 4%, they're happy, right? So I took that one deal and I took a hard money loan for the rest of the money. And I did my first flip. So I used $40,000, and in 4 months, I made a $20,000 profit. Now, if you think about it, right, it depends how you calculate your cash on cash. Should I be calculating my cash on cash based on the money I put in, the money my friend put in, which was $40,000? On that $40,000, I made an extra $20,000. Now, did my effort go into it? Of course. Did my time go into it? 100%. But really, that was the start. So what was the return that I created on that? And this is important to think about, that if I had paid cash for the property out of my pocket, right, and I had made the same amount of money, $20,000, that would not be the same as me borrowing money from Mr. Chase, meaning Chase Bank, right, JP Morgan Chase. If I borrowed the money from there, really, how much did I have out of my pocket personally? Zero. How much did my friend have out of his pocket? $20,000. And yet, in 4 months, right, I had made a $20,000 profit. So In that, this is net after expenses, after taking interest rate out, after taking everything out. This was net profit, 20,000. See, then I tried to repeat the same process over again a second time. Second time on the same money, I made a profit of $32,000 a second time. Then I tried to do it a third time, and a third time the property didn't sell within that year. It went into the next year. So I only took half the profit for that particular year. So on the first turn, I made 20, second turn, I made 32, and the third turn, I am taking half of the profit, and that half of the profit was $22,000. So think about that. That's 4, right? And that's 3 and 2, that's 5, and 74,000. So $20,000 I had borrowed from Chase, $20,000 I had borrowed from my friend Freddie, and guess what I made on that money? I had made $74,000 on the money that I borrowed from Freddie and on the money that I borrowed from Chase. At the end of the year, I gave Freddie his $20,000 back. I gave him half the profits back to him. So $20,000 he gets back, he makes another $37,000 on top of that. And then I put the $20,000 back in Chase on my home equity line, and I get $30-some thousand in my pocket. So now the question becomes is, what is my rate of return, right? I took the Chase interest into account. I gave Freddie the money back. You realize I had created out of thin air about $30-something. The great part about real estate is this. You literally, if you understand how to invest properly and how to invest safely, you can get a tremendous return. And what it does is, I call it the great equalizer, because it really doesn't matter how tall you are, how short you are. What is your age? Where did you come from? What is your ethnicity? How much you know or how much you don't in terms of how literate you are, if you went to college or if you didn't, who your parents were and what their net worth was. It's based on one thing. It's a learned skill set that it puts us all equal. Now, that doesn't mean that if you were not equal from the standpoint of that, maybe we will not be able to take advantage of all the same opportunities because where we come from. But real estate, a deal doesn't judge you, and real estate doesn't judge you because it lets you grow based on your desire, and it's not dictated by outside forces. See, to invest in the stock market, you need to have some money. To do crypto, you need to have some money. To do anything else, you need money. Yet, a bank is willing to lend you on real estate because it is a tangible asset. So what is the next one? The next one is, what do you mean by all-in cost, right? So this is a term that I use or we use in Mastery. And what do I mean by all-in cost? And this is something important to understand. So all-in cost, what we always mean is, what is the purchase price of the property? What is the rehab price of the property? What are your carrying costs? And what is the cost of money, meaning your finance costs in the property? That is your all-in cost, meaning if I add all of that together, so if I buy a property for $150,000, if I rehab the property for $50,000, if I have other costs of $20,000, then my all-in cost is $220,000. Why is my all-in cost important? See, here's why all-in cost is important, is that the delta between your all-in cost versus the value of the property, that is your spread, that is your equity in that particular property. That is why your all-in cost in any property, anytime you're investing, your all-in cost is one of the most important things that you have to understand. So if I buy a property, let's say, and I have to put 20% down, or I have to put 10% down or 15% down, right, to buy the property. And then that property is going to create returns for me in the tune of, let's just say, if I invested $40,000 invested in a property out of my pocket. So if I have 40,000 invested out of my pocket, and then let's say every year the property nets me after expenses, let's say $10,000 a month, right? So now most people would be like, oh my God, Andrew, that is a phenomenal return, right? That is a 25% cash on cash return. What does that mean? That means on 40,000 invested, I'm going to make $10,000. Fantastic. Great. The problem is this. What if I don't have the $40,000 to put down as down payment, right? So why is that important? Well, it's important because how else do you continue to grow? How could I have continued to buy properties if all the time I would have had to bring money out of my pocket, right? See, the reason most people in real estate don't grow is not because they don't have the motivation, is not because they're lazy, right? Most people, they are motivated. Today people consume more information, be it real estate, be it about anything, than ever in history because that much information is available. Yet, the reason most people are not able to grow because they can never figure out, where am I going to keep coming up with the money for down payment, right? That's one of the biggest challenges most people have. So to me, and this will be the last definition for today, and that will be is what is a home run deal, right? A home run deal by my standards, and mind you, all the definitions we're talking about are based on my standards, based on the standards that we use in Mastery, right? A home run deal is not a deal where you have a 20% return. A home run deal is not a deal where you have a 40% return. A home run deal is not a deal where you have a 100% return. You're like, well, Andrew, what do you mean? Well, if I invest, say, 50,000 in the property to buy the property, to rehab it or whatever it is, and I have $50,000 down payment out of my pocket. If I make $10,000 at the end of the year, what would that be? Well, you're making about a fifth of return. You're making a 20% return on that particular property, right? On 50,000 invested, if I make 25,000, that would be a 50% return on that property. Let's say I invest 50,000 and I make $50,000 on the property. Be kind of ridiculous, but let's just say I do. What would that be? Well, that would be 100% return. Is that good? In fact, it's great. It's fabulous. But we don't call that a home run deal. A home run deal, it only qualifies one way. Number one is does this property have a minimum of 25% equity in it? Remember the all-in cost we talked about? Purchase, rehab, and all the costs into it. So if I buy the property at 100,000, I fix it for, let's say, 50, I have 20,000 other expenses, I'm in the deal for $170,000. Now, on the back end, if I have minimum of 25%, minimum, I said, if I have 30% equity, it's great. 40% equity, fantastic. Right? If I have a minimum of 25% equity, that's the first thing we look at to call it a home run deal. But it's not a home run deal yet. That's just one criteria. We have three different criteria. Number one is it has to have 25% equity. Number two criteria is it has to have cash flow, right? So if it's a single family property, then, and it's a property that I bought, let's say for 150,000, 200,000, then it needs to make a minimum every single month, minimum of 450 to 500, 500 being ideal, net cash flow after all expenses. $500 per door net on a single family property after all expenses, right? This is important. And then there has to be a third one. So now think about this. If you buy a property and you fix it up, your all-in cost, purchase, rehab, any other cost, is, let's say, $120,000. That's your all-in cost, right? You have 25% equity in that property. And you make a net profit after expenses on rental income of $500 a month. Is that good? It's great, fantastic. But what if you bought that property for $300,000 and then you did 50 in work and then you have another 30 in expenses? Now, what is your all-in cost? Now your all-in cost is close to 360, 370, 380, somewhere in that ballpark. Now, if you're only making a $500 on that expensive a property, equation doesn't work, right? But you said, Andrew, I thought you said it was minimum $500. This meets the criteria. But we have a third one. Remember, the first one was equity. Second one was cash flow. And the third one is what we call DCR, debt coverage ratio. What does that mean? That's net operating income of a property divided by principal and interest, right? When we look at debt coverage ratio, this is not a DSCR we're looking at debt coverage ratio, right? In ratio of the debt on the property, how much it's a ratio between the two. So net operating income divided by principal and interest, that number, I always want to hit a minimum of 1.33. That's the number we want to hit. So if a property has three criteria, right? Number one is equity. Number two is cash flow. And then number three is a DCR ratio of 1.33. We call that a home run deal, right? That is a home run. Why? Because guess what? That accomplishes our fundamental goal that we have, that I feel everybody in real estate should have, is 2, 5, and 7. What does that mean? It means in 2 years, you have 5 properties that can all be paid off in 7 years. Now, I know for some people, they'll be like, well, Andrew, why would I want to pay the property off? That's crazy. Guys, that I'm going to leave for a further discussion. There's a method to this madness. Trust me. If you can understand the basic principles of 2, 5, 7, you will be wealthy for the rest of your life. That's 2 years, 5 properties, get them all paid off in 7 years. We call that cash flow for life. This is Andrew Holmes. Again, if you're not a member yet and you're watching this on the web, on one of the social media platforms, and you're not a member, become a member of Burke Cashflow Investors, or invite your friends, invite your family. Every single week, we do it 3 times a week, 5:30, that's Central Time. And what our goal with this is so that we can all learn and grow together as a group. The next drawing will be right after the next 3-day for the next prize for this. So every 3 months, we do a drawing for somebody that refers the most amount of people into the group. And then we take all the people that are members of the group and all your friends. So we keep track of how many people you referred to the group. So invite your friends, invite your family, invite other fellow investors that you think would love to hear some of this information and would gain and learn from some of this information, so we can all be a part of the community. And hopefully you'll be like a couple of the last winners we had. Trinidad on the first contest won a full set of appliances. And last one was Miss Amal and her husband that won a cruise for 2. And the next prize will be something equally fun. And that is something that, hey, it's your job, man, to make sure that Miss Jennifer gets that decided, because I was supposed to announce that today, and we kind of have not picked that out yet. So it's something big, it's something fun. We're building up to giving a Mercedes away. Remember what I had said. We're building up to every year giving a Mercedes away. That's what I want to do. You know, I know some people are going to think, Andrew, you're crazy. I am a little bit crazy, but I think that'll be damn fun. And why? Because everybody's a part of learning and growing together as a community. Having said that, thanks a bunch, guys. Have a good day, and we'll see you on Monday. Have a safe weekend.